Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
How does Black Swan prepare for constant intervention by central banks? The reality is we cannot prepare for it. You just never know. You never know how to play those. A lot of times you can get cute and you can fade the central bank move and say, well, it's not going to last. But I don't think you can. It's a market hazard. And again, the beauty of staying back intermediate term as opposed to trying to trade short term is the fact that you can sit through those. That movement in the Swiss franc, because of the intervention, was reversed in about 2 or 3 days. If you're trading in the spot market, holding a highly leveraged position, guess what? You got blown out. But if you're trading in the options market and you have a 3-6 month option, sooner you're going to sit through that original adverse move and just watch and give yourself time for it to come back, and it would have. So you really can't. You really can't get in front of those. Maybe some people that have incredible knowledge, inside knowledge. We sure don't, and I don't think most people do. So it's just a hazard of the market. What are the fundamentals to move the euro up today on the BOE decision? Since there's no change. Good question from John. If you don't know, the pound soared today. The euro is up strongly today when the Bank of England decided not to raise interest rates. There's a background idea that, hey, they're not going to increase their quantitative easing as much as expected. I mean, you get these silly reactions to news items like this. The euro and the pound have fallen off a lot lately. Maybe it's just a corrective move on an excuse day to day. And this is the problem you get into trying to tie your fundamentals to day-to-day and short-term news items. It's a very tough thing to do. But from a fundamental standpoint, there's really nothing to support the big move back in the Bank of England today. It doesn't change anything in the longer-term fundamentals in the British pound, which we happen to be short on a long-term basis in the British pound. So we're watching it. But again, if the British pound continues back, there's something going on that we missed. But it's these types of intraday daily moves that can really make us crazy trading short term. But again, if we step back, make a small bet, and buy time with the currency option, we can sit through these and evaluate these more readily and more calmly. And I just think it's just an adverse move to the recent price trends. A little backing and filling is really our view at the moment. Again, question on the British pound, the move from 130 to 160 on the fundamentals in the UK economy. Part of it, I think part of that move from 130 to 160 in the British pound that we saw, the British pound, if you remember, the British pound was the first currency to break against the U.S. dollar. The British pound broke in November of 2007 after it hit about 211 against the U.S. dollar. The reason it did it, the pound of the major currencies, the UK is the most exposed to the financial services industry, and it broke first and fast and went a long, long way on a relative basis. The euro continued to go up for about 3 or 4 months, I think, and I have to look at the charts. But the euro didn't break till several months after, and really didn't break as far. So you could say part of that move back from 130 to 160 was one, retracing, just some of the incredible damage that it had. Number two, there was really, again, more concern starting to be feed into the euro. If you remember, talk about this Eurozone banking stuff, and there was talk about problems in Eastern Europe. I think you saw some money flow inside Europe move from the euro to the pound in and of itself in that move. So you had a pound move against the dollar that was driven not only against the dollar UK fundamentals, but the pound euro fundamentals going on, the euro concern. So part of it was that. Again, if you looked at it in isolation in the UK fundamentals, the move wasn't, it really didn't make a lot of sense. But but you can justify it based on just percentage moves. We happen to think the UK economy is toast long term, and the fundamentals will ultimately play out here. And this big move back up, we think, is a pretty good setup to take a shot at that. Question from Andrew. To increase consumer spending and sidestep the bank liquidity trap, why not the Fed decree all current accounts go up to 100? Not quite sure what that says, but if it's what I think, the current account was a big driver of global liquidity, but the current account deficit in the U.S., which everybody thought was the driver of the dollar, and I think it turns out that the dollar is the driver of the current account, but that's a whole other discussion. But the current account got very bad because we had the implicit policy of using the dollar as the funding currency globally because of the derivatives. So the current account increase was part and parcel to that major liquidity flow. And the fact is they may be trying to get back into that, and that is exactly the muddle-through scenario we're looking at. And the key factor that can prove that is not only, number one, Chinese exports, but if the current account deficit starts in the U.S. starts to get worse again, meaning the U.S. consumer is reducing his savings, the U.S. dollar is starting to be demanded offshore and supplied offshore, supply of dollar credit offshore. If that happens, then it builds that scenario of using the dollar as a global funder. It comes back into play. So the current account is really a symptom of what's going on, and that's not necessarily a driver, I guess is my point. Let's see. Lynette, did you see any more questions? Oh, here we go.
I think you got to most everyone's questions, but
Okay.
Depending on the time you have available, if you're able to answer another question or two.
Yeah, let me see what we have here. Question, what about the Financial Times as a source of fundamental information? Financial Times is great. We read it. I actually do get that in hard copy and spend some time during the day trying to read most of the Financial Times. It really is a great source of information. I'd say if you're a currency trader or an international, if you want to understand things internationally, the Financial Times just blows away the Wall Street Journal in a very big way. We don't even subscribe to the Wall Street Journal anymore. We read it online a little bit. Not to say it doesn't have some great stuff, but the Financial Times is very focused and very detailed, and you get a lot of great ideas from the Financial Times, so I'd agree with that. Oh, question about the great 10-year auction yesterday from William. Again, we're not bond analysts, but when we saw that, and it said to us that, hey, it said to us two things that obviously didn't play out yesterday to a degree, and not today, but that much money flow back into the fixed income area suggests to us that people want to come out of they're a little concerned again about green shoots. If people if people thought we were in some type of V-shaped recovery and stimulus was gaining traction, and this idea of green shoot was in play, we doubt we'd see people moving back into bonds in a very, very big way. So we happen to think this is probably a negative indicator for the stock market and builds the story of risk building to see that much money move back into bonds at that relatively low yield. That's what it says to us. And William makes the point, and therefore the strengthening of the yen. It was part and parcel to that risk move that we saw yesterday, obviously not today. But that's the way we saw that, where some people took it positive for the stock market. We don't necessarily think so.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.